Sentiment analysis in the crypto market is crucial for understanding market trends and predicting future price movements. By analyzing social media, news articles, and online forums, we can identify bullish and bearish signals that can help us make informed decisions. In 2025, mastering sentiment analysis will involve using advanced AI and machine learning algorithms to process large amounts of data and extract meaningful insights. This will enable us to identify key trends, gauge market sentiment, and make better investment decisions. By staying ahead of the curve and understanding the nuances of sentiment analysis, we can capitalize on opportunities and mitigate risks in the ever-evolving crypto market. Bullish signals are indicators that suggest a positive sentiment in the market, often leading to upward price movements. These signals can be identified through various technical analysis tools and chart patterns. For instance, a bullish engulfing pattern occurs when a small bearish candle is followed by a larger bullish candle, indicating a potential trend reversal. Additionally, moving averages can provide bullish signals when the short-term average crosses above the long-term average, suggesting a strengthening of the upward momentum. Volume analysis is also crucial, as increasing volume during an uptrend can confirm the strength of the bullish signal. By understanding and recognizing these bullish signals, investors can make informed decisions and capitalize on potential market opportunities. Bearish signals are indicators that suggest a decline in the market or a particular asset's price. These signals can be identified through various technical analysis tools and chart patterns. One common bearish signal is the head and shoulders pattern, which forms when the price reaches a peak, followed by a smaller peak, and then another peak that is lower than the first. This pattern suggests that the buying pressure is weakening, and sellers are taking control of the market. Another bearish signal is the double top pattern, where the price reaches a high point twice but fails to break through, indicating a potential reversal. Additionally, moving averages can provide bearish signals when a shorter-term average crosses below a longer-term average, suggesting a downtrend. Understanding these bearish signals can help investors make informed decisions and protect their investments from potential market downturns. Trading with emotions is a common mistake that can lead to poor decision-making and significant financial losses. Emotions such as fear, greed, and excitement can cloud judgment and cause traders to make impulsive decisions. To avoid this, it's crucial to develop a solid trading plan and stick to it, regardless of market fluctuations. This includes setting clear entry and exit points, as well as risk management strategies. By maintaining discipline and focusing on the long term, traders can minimize the impact of emotions on their trading decisions and improve their overall performance. Neglecting security is a common mistake that can lead to severe consequences. It's crucial to prioritize security measures to protect your data and privacy. Implement strong passwords, use encryption, and keep your software up to date. Additionally, be cautious when sharing sensitive information online. Always be vigilant and stay informed about the latest security threats and best practices. By taking these steps, you can significantly reduce the risk of falling victim to cyber attacks and data breaches.